Oh boy, I think I may have found the market crash. Please don't look at UiPath or Salesforce. Okay, we need to look. It's bad. And we need to explain what's going on and what this could mean for the broader market, especially if you're looking at trading tomorrow, because let's just say while C3 AI might be up 8.7% on the day, you're still dragging like an anchor around the bottom that just hit a tiny little pebble in terms of your stock actually going up. Yikes. UiPath, on the other hand, is like an anchor that just fell into the Mariana Trench, down 29%, with Salesforce also down 15%, though Salesforce at least had a little bit more of a recovery in 2023. So what the hell happened? What is going on? And how the heck do we trade this? Because, well, frankly, I like trading. As you know, this is my account. I'll do a quick shout out on this so we can move on. We got a coupon code expiring Friday for the courses on building your wealth. Our P&L for today, well, over the last 5 days is about 149,000. The account's up to 2114. And if we go to the trades for just today, we're at about 67K on trades today. So if you want those buy-sell alerts, make sure you're part of the Stocks and Psychology of Money group, link down below. We got a coupon code expiring Friday. And even though I try to send alerts and hope to make money, I can't guarantee that I can keep this going or you'll be able to make money. Now, with that said, what just happened with Salesforce? Yes, this is a big deal. Salesforce is down about 16% on the same day that Nvidia hit its all-time highs, and Dell also hit its all-time highs. At what point during the trading day, I had Dell call options that ended up more than 2.5xing running into the close. Like, Dell is exploding, which is really exciting if you're playing calls or speculating on the stock, but what I'm really worried about is exactly what I just said, that it's speculation. Remember, only about 2% of Dell's revenue actually comes from artificial intelligence, yet because they got a shout out from Nvidia, their stock basically doubled. That's insane. And going into this, we know that artificial intelligence software companies are probably one of the riskiest bets in this market. Except here, you're going to learn about exactly what's going on. Now, before the earnings that we got today, we already knew that there were some problems brewing in AI. Stable Diffusion, for example, the company that makes those, text-to-image generations that Coca-Cola featured in some of their advertisements, is, at least according to the information, running out of money and potentially unable to cover its debts, despite having sky-high valuations in the billions of dollars range, right at the beginning of the AI euphoria we saw last year. Well, what's changing? What's going on at these companies? Well, for Salesforce and UiPath, both of them missed on their forecasts, but it was their commentary that actually led me to be a little bit more concerned that we could actually be starting to see the turn in the artificial intelligence revolution. Now, don't get me wrong, I'm exposed to stocks like Nvidia, and I don't want to see Nvidia tank. In fact, when Nvidia goes up, it's a pretty dang easy trade to play, especially when you trade some of the adjacents like Supermicro or Dell or some of the others. The problem, though, is once we start getting an AI software collapse, Nvidia will eventually follow. This is sort of my outline, and then I'll tell you some of the things that I saw today, and heard in the earnings call. I listened to every word of the Salesforce earnings call, for example, and I've been studying what's been going on with the earnings of these other companies. Here's how the AI sector collapses and tanks the entire, stock market, which wouldn't be great. First, in my opinion, is like phase one is software revenues don't actually materialize or grow the way people hope. In other words, people think software revenues are going to explode because of artificial intelligence, but what actually happens is it's like so much easier to create software that there's a lot more competition. And what you actually have to do is create a pricing war as everybody implements their chat bot. And we're not really seeing like a new wave of AI, right? We're like getting these incremental improvements on AI. So everybody gets a new chatbot, cool. Now everybody has one, so competition goes up and potentially you have even more chatbots. So what you've really done is lowered software pricing rather than increased software pricing. Yikes, that's kind of exactly the opposite of what you would have expected, but that's kind of how the market works. The market usually does the opposite of what you think is gonna happen because what you think is gonna happen is already priced in. That's one of the lessons of the stock market. But anyway, Once you get a bunch of competitors in the software space, software basically becomes a commodity. Software stocks then start collapsing first, like we just saw with UiPath down 29.6%, Salesforce down 15%. That's like $40 billion that Salesforce just went to. That's like Elon's stock comp plan just evaporated into thin air. Now, chip designers like Nvidia might end up holding up at first, since Nvidia doesn't really care where the chips go, whether it's, one software provider like a Microsoft or 100 different providers like Microsoft and 99 other startups. It really doesn't matter. As long as the total addressable market of software gets addressed by however many companies it is, Nvidia still benefits as a provider of the tool that can provide that compute. Great. So Nvidia holds up. But eventually you get a lot more software competition that then continues to press down pricing. And without a new leap in AI technology, yes, we can compute the same stuff faster, but without a leap in like artificial general intelligence or something beyond just chatbots, what usually will happen is you'll start to see chip orders slow, at first slowly, and then suddenly. It starts slow, then it happens suddenly. It's kind of like, why is Amazon going, you know what, we're going to wait on getting the any more H100 chips. We're just going to wait for Blackwell. That's an early warning that some of these software companies aren't actually seeing as much of an explosion in demand as would have maybe otherwise been expected. In fact, when Nvidia said that, it could have been a massive red flag for what happened with Salesforce and UiPath, which at least Salesforce has their products on Amazon servers. Something to keep in mind. Now, at least some of their products. After chip orders slow, chip supply shortages start to evaporate. When shortages evaporate, pricing stabilizes for new chips. But not only does pricing stabilize for new chips, old chip pricing plummets. Who remembers this during COVID? You were like paying, people were literally flipping graphic cards from their computers for a premium during COVID because everybody wanted to mine basically Ethereum, frankly, or various different cryptocurrencies, though a lot of them were using ASICs, a lot of them were also using GPUs. And so people were literally flipping chips from their computers and uninstalling graphic cards just to make a buck, knowing that eventually chip prices would stabilize and come down again, and then old chip prices would collapse. Well, that's exactly what happened. Then the plummet of pricing leads new potential chip customers to say, maybe we're not going to stock up as much on chips because we don't want our balance sheet to get destroyed. Then all of a sudden, margins go back to normal at companies like Nvidia, and EPS growth potentially ends up turning negative, and then the stocks tank. That all takes a while to come through, and remember when I say that there's this balance sheet fear, what I'm really saying is you've got this potential for, hey, if we buy 35,000 H100s at a value of, let's just do it really quick. Let's just say $35 just to keep the math simple. Sorry. Yeah, 35,000 at $35. To keep the math simple, that would be $1.2 million. And if, let's say all of a sudden that the pricing of each chip collapses to $7,000 for an H100, well, all of a sudden you basically lost somewhere around, 7 divided by 35, you lost about 80% of the value of that asset that was sitting on your balance sheet. That's not good. Now all of a sudden you see this balance sheet expense, and then all of a sudden you're having to create markdowns on your balance sheet. That makes companies look bad. So that also, in addition to negative EPS growth, leads companies to fall. So this is a real risk. But now, what did we actually hear from Salesforce? Okay, so now you have an overview, right? So you have an overview of what happened in the stocks first, then how does the whole AI world collapse, and then what's actually happening at Salesforce. Okay, ready for this? Operating income expectations for Q1 came in 70 basis points lower than expected. Big deal. Not a big deal at all. It's like literally, who cares? Operating margin, as expected. Fine. Q2 revenue forecast came in 1.3% lower than expected. Huh. Okay, that's interesting. That's not that big of a miss. Why is the stock down 15%? Okay, subscription revenue forecast revised down slightly to less than 10% growth for the company. Really? Why would the company be growing less with all of these AI tools? That's really weird. We should be growing faster, not slower. Why are we growing slower with AI? I thought we were going to grow faster with AI. And that is the problem. That is exactly the problem. So, what did Salesforce tell us? Well, first, they bagged on chatbots. In fact, multiple times, they bagged on chatbots. They bagged on chatbots and said, hey, commodities like chatbots, chatbots are going to become commodities. Everybody's going to have one. What makes us different is that our chatbots understand your company's data. And I'm like, okay, all right, wait. So your sales pitch is chatbots are a commodity, but your commodity is better. Got it, Salesforce. Okay, interesting. Then they gave some example. They said they're seeing good demand. Their customers are excited. Talked about Air India. They talked about CrowdStrike. Okay, a lot of exciting references. Talked about how they're saving 20,000 hours every month in programming work thanks to artificial intelligence. And we now provide personalized summaries thanks to AI in Slack. Bro, summaries. Stonk should be up, right? Then we get to the real color, which is there's continued pressure in professional services. Customers are delaying or slowing their projects. But we're seeing a strong demand for data, but only after we make pricing and packaging changes. Interesting. So, in other words, there's continued pressure in professional services and customers aren't really buying your stuff. So you're reducing the price, and when you reduce prices, then people are interested in it again. Interesting. Okay, well, how has revenue growth been the last 2 years? Revenue growth has been consistent the last 2 years. But customers are really looking for shorter duration projects. But we are benefiting from price changes over the last year. Yes, okay, got it. More cutting. Customers don't want to do the big AI projects because they're like, we already got our chatbot. We got it for free, whatever. Then an analyst literally, and I was like, basically screaming, this is like competition, right? This is a sign that there's so much software competition that prices are coming down, which is the beginning of the AI collapse. And an analyst replies and says, hey, well, what about crowding in the field? And Mark Benioff and the team, they're like, wow, it just takes companies a lot of time to adjust and integrate. Remember, customers can leverage data. And in the meantime, they literally did what I'm about to say, okay? And I'm like, I literally wrote on eHack, I'm like, this is so cheesy. I literally wrote this down. But anyway, they say, and I'm paraphrasing a little bit. You can listen to the earnings call, but I'll just give you the paraphrase on it. They're like, did you take advantage of Kevin's coupon code expiring this Friday, 11:59 p.m.? Prices are going up. They're going straight up this year. Not going to get in for a cheaper price. Okay, sorry, I had to do that. No, they literally said, in the meantime, so they were talking about mergers and acquisitions, and they're like, we're going to be cautious. We don't want to cannibalize our existing customers. And I'm like, okay, that's interesting. So you're not actually enthusiastic about sort of adding features because you're worried about losing revenue from some of your customers if you add too many products. Interesting. And then right after they say that, Mark Benioff is like, look at our amazing cash flow. Maybe only a few other companies have ever delivered cash flow like this. The numbers are pretty epic. I wrote down, this is turning cheesy. I'm like, yes, it is true. The Salesforce cash flow numbers are very, very good. I will give them that. The cash flow is delicious. $6.2 billion in 3 months. They've got a PEG ratio of 2.09. Like, the valuation isn't kooky, assuming that they can grow earnings per share 11% over the next few years. But I'm not concerned about that. I'm concerned about EPS growth actually turning negative because they need to cut. Because they can't keep selling this AI crap because people are tired of the AI crap. It's like, I get it. I can generate an image now, and I have a chatbot. So how do we keep delivering the numbers then, says Mark Benioff. Yes. What we're going to do is we're going to have a, quote, deeper inspection of the pipeline. That's not like a colonoscopy. That's actually just a fancy way of saying we're going to put more pressure on our sales staff to make sure they just keep calling people over and over and over again to make sure they close deals. Then they literally went into ripping on OpenAI for ripping off newspapers and now striking deals with them. They were begging on ChatGPT. Probably because Einstein sucks and they have to. Oh, I said it. I'm sorry. Anyway, I think this is a huge red flag that AI is basically creating substantial software deflation. Now, you look at C3AI and you're like, oh, but Kevin, they're up 8%. That's true, but like 21% of their revenue comes from the federal government. That's cool. Like, so does Palantir. That's great. But there are now so many choices that I actually think all of these software companies and their moats are actually getting diluted. And so, sure, congratulations, C3AI, your revenue went up 19%, your gross profit went up 8.5%. What does that tell me? You had to reduce prices or your costs went up. Your sales expenses went up 22%. Revenue went up 19%. That means it took you more to actually get that money at a lower margin, and your net losses widened. Yeah, you've got a strong balance sheet from when you IPO'd, but still, it's not great. Then, literally this morning on the course member live stream, somebody asked me, hey, Kevin, what do you think about, or maybe it was in the public live stream, I can't remember which one it was. Remember, if you're a course member, you get all the course member live stream analyses as well. But somebody asked, I think it was a course member, hey, can we analyze UiPath? And I'm like, all right, so here's the thing with UiPath. They create automation tools. Before artificial intelligence, that's great. That's a wonderful thing. Like, people want automation tools. That's great, and they're willing to pay for that. My concern, though, this morning when I was analyzing UiPath was, does AI help or hurt them? Because, see, AI could maybe help them make more automation tools, but if everybody else can just as easily now make those automation tools, what do you need UiPath for? Oopsie doopsie. Apparently the answer is yeah, UiPath gets hurt. So who might be the biggest winner here? Well, maybe companies like Microsoft, Amazon, Nvidia for a time being, but what happens when this process really rolls over? In other words, and again, software pricing collapses. We have not seen that in like the last decade and a half. I mean, quite frankly, since the dot-com bubble, software margins have really actually held up pretty strong. That's why software companies sell for a 2.6-ish PEG ratio. Software margins are higher, profitability is higher, stock-based compensation is higher. Everybody wants to be in software. But if everybody wants to be in software, and now everybody's leveraging artificial intelligence to make more software faster with less coding work, then the moat at companies, I hate to say it because I'm invested in a company like Palantir, but the moat at companies like Palantir or UiPath or Salesforce or whatever starts to go down. That's not great. So when that moat goes down, you get EPS negative growth. In other words, rapid growth after COVID makes sense. 2020, yay, rapid growth. 2021, yay, rapid growth. 2022, ooh, we're gonna lay off a little bit. 2023, AI, yay, rapid growth. 2024, oh, growth is flattening. So all of a sudden you kind of have this like skyrocket, a little bit of a slowing in 22, skyrocket due to AI, and then all of a sudden it's like, what? EPS growth is flat. Wait, EPS growth is now a negative. Oh no, it's now really negative. Oh my God! Stock valuations go through the roof and then they collapse, much like Black Monday. Now, Black Monday is actually a really interesting reference because if you look at Black Monday, one of the reasons, and people speculate over what really caused Black Monday, but Black Monday was deemed to have basically occurred because people were all of a sudden highly concerned about stock valuations again, and thinking that things were too overvalued. Now, something else that I thought was really interesting, and I got this from a team member. I want you to see this. This is crazy. So this should be bullish. So I want to sort of balance the negativity with bullishness just a little bit. So I'm going to go throw this picture up on screen. Okay, let's get that picture up. Okay, here we go. Oh, sorry, that was the P&L for today. Sorry. And I did trade with a little bit more than I usually trade with today, so my percent return today was a little weaker because I traded with a larger chunk, but it still went pretty well. Make sure you get those buy-sell alerts if you're not part of it yet, Stocks on Site. Look at this on screen here. This is crazy. This is a JP Morgan piece where they basically show that in the first 100 days, if the S&P 500 was over 10%, it basically always ended the year positive. Well, it did. The full year always ended the year positive. And in every single instance, the S&P ended over 14% higher by the end of the year compared to the prior year. In many cases here, 20%, 30%, 45%, with the exception of 1987, where the market was up 19% at the beginning of the year and only up 2% at the end of the year. Wow, what happened in 1987? Black Monday happened. You had a liquidity crisis and you had a fear that the stock market had just become overvalued. So, am I saying that we could have a Monday-style market crash? Well, yeah, at some point in the future that'll happen, and I'll probably be trading it. It'll be really entertaining. Could also be very scary, depending on which way you're trading. If you're buying puts, you might be really happy. But anyway, yeah, it's really interesting that the one time on their sheet that you don't actually get as high of an end of the year is a year that you're worried about valuations. And this is coming at the same time that we're talking about, can Nvidia really keep up the market this much longer? And realistically, the order is, can software revenues prop up the market for this long? And then will those continue to translate to Nvidia earnings? And when does that bubble pop? Let me know what you think in the comments down below. And if you have questions on those courses on building your wealth, make sure to email us at staff@meetkevin.com.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show shall not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF. I may personally hold or otherwise hold long or short positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuer other than Househack, nor am I presently acting as a market maker. Make sure if you're considering investing in Househack to always read the PPM at househack.com.